Imagine a quiet young man sitting alone in a small room, surrounded by towering stacks of books, reading page after page about the greatest investors who ever lived, taking careful notes, underlining sentences, asking himself deep questions, and slowly, very carefully, building a way of thinking about money, about life, and about wisdom that would one day make him one of the most respected value investors in all of Asia. That young man is Gautam Baid, and the book he wrote from that journey, called The Joys of Compounding, is not simply a book about investing. It is a book about becoming a better human being. It is a book about thinking more clearly, living more intentionally, and growing wiser, richer, and more fulfilled with every single year that passes. If you have ever asked yourself how the greatest minds in the world of investing think, how they build wealth quietly over decades, how they control their emotions when everyone around them is panicking, how they choose which businesses to trust with their money, and how they manage to live lives full of meaning and purpose while doing all of this, then this book has answers that are rare, deep, and genuinely life-changing. This is not a book you read once and put aside. This is a book you return to again and again, each time finding something new that speaks directly to where you are in life at that moment. Gautam Baid did not just write about investing. He wrote about the art of living wisely, and the two, as he shows so beautifully throughout the book, are far more connected than most people ever realize. To understand why this book matters so deeply, you need to first understand who Gautam Baid is and where he came from. He is not a man who was born into wealth. He did not grow up with a silver spoon, or a trust fund, or a famous family name. He grew up as an ordinary person who fell deeply in love with reading, with learning, and with the writings of great investors like Warren Buffett and Charlie Munger. He read their letters, their speeches, their interviews, and their books, not once, but many times, absorbing their wisdom the way dry ground absorbs rain. He worked in the finance industry, managing money for clients, and over the years, he developed a philosophy that drew not just from investing, but from history, psychology, science, philosophy, literature, and biology. He became what Charlie Munger would call a learning machine, someone who never stops feeding his mind, never stops questioning his assumptions, and never stops trying to get better. And then, he sat down and wrote this book, which is really a distillation of everything he had learned, organized in a way that any thoughtful reader can absorb, apply, and benefit from, whether they are a seasoned professional investor or someone who is just beginning to think seriously about their financial future. The very title of the book, The Joys of Compounding, contains a world of meaning that goes far beyond the mathematics of interest rates and returns. When most people hear the word compounding, they immediately think of money growing over time, of a savings account accumulating interest, of investments multiplying year after year. And yes, that is part of what Gautam Baid writes about. But the deeper idea, the one that runs through every page of the book like a golden thread, is that compounding applies to everything in life, not just money. Your knowledge compounds, your skills compound, your relationships compound, your reputation compounds, your habits compound, your wisdom compounds. Every good thing you do today, every book you read, every lesson you learn from a mistake, every hour you spend developing a skill, every act of kindness you extend to another person, all of these things add to your store of goodness, and over time, they multiply in ways that are impossible to predict, but are always, always positive. This is the great joy that Bade writes about. Not the cold, mechanical joy of watching numbers grow on a spreadsheet, but the warm, living joy of becoming more capable, more wise, more patient, and more human with every passing year. The book opens with the idea of a learning mindset, and this is not a coincidence, because for Bade, the ability and the willingness to keep learning is the single most important quality a person can develop. He believes, drawing on the wisdom of Charlie Munger, that the greatest investors in the world are not necessarily the ones with the highest intelligence, or the best connections, or the most expensive education. They are the ones who never stop learning. They are the ones who approach every new experience, every failure, every book, and every conversation as an opportunity to add something new to their understanding of the world. Munger himself often said that he never met a wise person who did not read constantly, and Bade takes this idea completely to heart. Reading is not presented in this book as a hobby or a leisure activity. It is presented as a moral obligation, a fundamental duty that every serious investor and every serious human being owes to themselves and to the people who depend on them. Bade writes in detail about his own reading habits, about how he approaches books not as passive entertainment, but as active conversations with great minds. He reads slowly and carefully. He takes notes. He tries to understand not just what an author is saying, but why they are saying it, what assumptions underlie their thinking, and how their ideas connect to ideas he has encountered in other books and other fields. He does not just read books about investing. He reads books about history, about biology, about physics, about psychology, about philosophy, about literature, about medicine, and about every other domain of human knowledge he can get his hands on. And the reason he does this is not to show off or to feel clever. The reason is that he believes, with deep conviction, that the best insights in investing often come from completely unexpected places, and that a person who has read widely and thought deeply will always have an edge over a person who has read narrowly, no matter how expert that narrow reader might be in their specific field. This idea of drawing on many different fields of knowledge to build a richer understanding of the world is one of the central themes of the book, and it connects directly to a concept that Munger popularized and that Bide explores at great length: the concept of mental models. A mental model is simply a way of thinking about the world, a framework, or a lens that helps you understand how things work and why they happen. Every field of human knowledge contains its own set of mental models. Mathematics has its models of numbers and patterns. Physics has its models of forces and energy. Biology has its models of evolution and ecosystems. Psychology has its models of behavior and motivation. Economics has its models of supply and demand and incentive. When you study multiple fields deeply enough, you start to accumulate a toolkit of mental models from all of these areas. And when you face a complex problem, you can draw on any tool in your toolkit to help you understand what is happening and what to do about it. Munger called this a latticework of mental models, and Bade uses this phrase with great affection and respect because he believes it captures one of the most important truths about clear thinking. The person who only knows one mental model will try to apply it to every problem they face, even when it does not fit, like someone who only owns a hammer and therefore treats every problem as a nail. But the person who knows 100 mental models from 100 different fields can pick the right tool for the right job, and as a result, their thinking is far more accurate, far more nuanced, and far more useful than the thinking of the person with only one tool. Bade gives many examples throughout the book of how mental models from unexpected fields illuminate the world of investing. The concept of natural selection from biology, for instance, can help you understand why only the strongest businesses survive in competitive industries. The concept of second-order effects from physics can help you understand why a seemingly good decision can have terrible long-term consequences that were not visible at the time. The concept of regression to the mean from statistics can help you understand why extraordinary performance in any area tends to be followed by more ordinary performance. As Bade walks through this world of mental models, he is also laying the foundation for a deeper point about the nature of investing itself. Most people think of investing as a purely financial activity, a matter of numbers and spreadsheets and market prices. But Bade sees it as fundamentally a thinking activity, a discipline of the mind that requires clarity, patience, intellectual honesty, and a willingness to be wrong. The numbers matter, of course, but the thinking that goes into interpreting those numbers, the judgment that guides decisions about which businesses to trust and which to avoid, The temperament that allows you to hold steady when markets are falling and everyone around you is selling in a panic. These are not numerical skills. They are human skills. They are skills of character and wisdom, and they can only be developed through years of reading, thinking, reflecting, and learning from experience. One of the most important concepts in the book is the idea of the circle of competence. This is another idea that Baid borrows from Buffett and Munger, but he explores it with great depth and originality. Your circle of competence is the area of knowledge where you genuinely understand what is happening, where you can make judgments with real confidence because your understanding is deep and tested. Outside your circle of competence, you may have opinions, but they are not based on real knowledge. They are based on surface impressions and guesses, and acting on them in the world of investing can be extremely costly. The wise investor, Baid argues, does not try to have an opinion about every business in every industry. Instead, the wise investor focuses relentlessly on the area where their knowledge is deepest and most reliable, where they can genuinely assess the quality of a business, the strength of its competitive position, the integrity of its management, and the reasonableness of its valuation. Within that circle, the wise investor acts with confidence and decisiveness. Outside that circle, the wise investor admits ignorance and does nothing. This idea of knowing what you do not know, of recognizing the boundaries of your own knowledge and respecting them, is one of the hardest lessons for most intelligent people to learn. Intelligent people are often tempted to have opinions about everything, to venture judgments on subjects far outside their area of genuine expertise, because their intelligence makes it easy to construct plausible-sounding arguments, even when their actual knowledge is shallow. Baid writes about this tendency with great honesty, including his own experience of making mistakes by venturing outside his circle of competence. And he is very clear about the antidote, which is not more intelligence, but more humility. The willingness to say, I do not know enough about this to make a reliable judgment, and then to actually stay quiet and do nothing, is one of the rarest and most valuable qualities a person can develop, both as an investor and as a human being. But staying within your circle of competence does not mean staying small or staying still. Baid is very clear that your circle of competence can and should grow over time as you read more, learn more, and gain more experience. The goal is not to draw a tiny circle around yourself and never venture beyond it. The goal is to constantly expand the circle, slowly and carefully, always making sure that new areas you move into are areas where you are building genuine knowledge and real understanding, not just the illusion of understanding. This is where the compounding of knowledge comes in again. Every book you read, every case study you analyze, every investment you make and reflect on afterward, every conversation you have with a knowledgeable person, all of these experiences add to your circle of competence, slowly expanding it outward, making you capable of understanding and evaluating more businesses, more industries, and more situations than you could before. The next major theme in the book is the concept of quality, and specifically, the idea that the most rewarding investments over the long run are almost always investments in genuinely high-quality businesses. This is a lesson that Buffett himself has spoken about at great length, often contrasting it with his earlier approach under the influence of Benjamin Graham, who taught him to look for cigar butt businesses, meaning companies that were so cheap that even though they were terrible businesses, you might be able to squeeze one last puff of value out of them before they finally collapsed. Graham's approach worked well in the early decades of Buffett's career, but as Buffett grew older and wiser, and as Munger's influence grew stronger, he came to understand that the most powerful force in investing is not finding cheap garbage, but finding wonderful businesses and holding them for very long periods of time. Baid explores this idea with great richness and depth. A truly high-quality business, he explains, has several key characteristics that set it apart from ordinary businesses. First, it operates in an industry where the economics are genuinely attractive, meaning the industry is not dominated by cutthroat competition that destroys profits for everyone involved. Second, it has a strong and durable competitive advantage that protects it from competitors, what Buffett famously called a moat. Because just as a moat around a castle keeps invaders out, a competitive moat around a business keeps rivals from taking away its customers and eroding its profits. Third, it is run by managers who are not just capable, but genuinely honest and trustworthy, people who treat the shareholders as partners rather than as sources of cash to be extracted. Fourth, it has the ability to reinvest its profits back into the business at high rates of return, so that every rupee or dollar earned can be turned into even more earnings in the future. And fifth, it has a long runway of growth ahead of it, meaning there are still many years of expansion and opportunity in front of it. When all of these qualities come together in a single business, the effect over long periods of time is almost magical. A business that earns high returns on its capital and can reinvest those returns at equally high rates, compounded over 10, 20, or 30 years, creates an amount of wealth that is genuinely staggering, far more than most people can intuitively imagine when they first encounter the mathematics of compounding. Baid uses many examples and illustrations to bring this point to life, showing how a business that grows its intrinsic value by 15% per year, year after year, becomes worth enormously more after 20 or 30 years than even the most optimistic initial estimate might suggest. And he makes the critical point that for this kind of compounding to work, you must not disturb it. You must not sell too early. You must not get distracted by short-term price movements. You must not let fear or greed interrupt the process. You must simply hold on and let the compounding do its work, which requires patience, conviction, and what Baid calls the most underrated quality in investing, and that quality is temperament. Temperament, as Baid uses the word, does not simply mean being calm or even-tempered in everyday life. It means having the emotional and psychological architecture that allows you to behave rationally when the world around you is behaving irrationally. It means being able to buy when everyone else is selling in panic, and to sit quietly and do nothing when everyone else is chasing the latest hot trend. It means being able to hold a stock for 5 or 10 years when it is performing poorly in the market, because you understand that the market's opinion of the business and the actual quality of the business are two very different things, and you trust your own analysis over the market's mood. It means being able to read headlines about economic disaster and market crashes without losing your nerve, because you understand that such events are a normal and inevitable part of the long-term investing journey, and that they are actually opportunities rather than threats for the patient, well-prepared investor. Baid writes with great insight about the psychological challenges of investing, drawing on the fields of behavioral finance and cognitive psychology to explain why even intelligent, educated people so often make terrible decisions with their money. The human brain, he explains, was not designed for investing. It was designed through millions of years of evolution for survival in a very different world, a world where quick reactions to immediate threats were essential for staying alive. In that world, the instinct to flee when you see a predator was a genuine lifesaver. But in the world of financial markets, that same instinct, applied to falling stock prices, leads to exactly the wrong behavior. When markets fall sharply, your primitive brain interprets the price drops as a signal of danger and tells you to sell and run to safety. But the intelligent response is the opposite: to recognize that lower prices mean you can buy wonderful businesses more cheaply, and to use the panic of others as an opportunity rather than a signal to join the stampede. Among the many psychological biases that Baid discusses, a few stand out as particularly important and particularly dangerous for investors. The first is loss aversion, which refers to the well-documented human tendency to feel the pain of a loss much more acutely than the pleasure of an equivalent gain. Research in behavioral economics has shown that most people feel the pain of losing a certain amount of money roughly 2 times more intensely than they feel the pleasure of gaining the same amount. This asymmetry of feeling leads to all kinds of irrational behavior, such as holding on to losing investments far longer than makes sense, because selling them would mean realizing the loss and making the pain feel real and permanent, even though the economic loss has already happened, regardless of whether you sell or not. The second major bias is overconfidence, which is the tendency to believe that your own knowledge, skills, and judgment are better than they actually are. Study after study in psychology has shown that most people, when asked to assess their own abilities in almost any domain, rate themselves as above average, which is, of course, statistically impossible for the majority. In investing, overconfidence leads to excessive trading, to taking concentrated positions in things you only think you understand, and to dismissing warning signs that a truly humble and careful analyst would take very seriously. Baid is particularly thoughtful about this bias because he has struggled with it himself, and he writes about his own experiences with intellectual honesty that is both admirable and instructive. The third bias is what psychologists call recency bias, which is the tendency to give too much weight to recent events and too little weight to longer historical patterns. This bias leads investors to buy stocks that have recently gone up sharply, assuming that recent strength is a reliable guide to future performance, and to sell stocks that have recently fallen, assuming that recent weakness will continue. Both of these impulses tend to be wrong more often than they are right, because markets have a powerful tendency to revert toward fair value over time, meaning that things that have gone up too much tend to come back down, and things that have fallen too far tend to recover. The fourth bias is herd mentality, or what is sometimes called social proof, the deeply human tendency to feel comfort in doing what everyone else around you is doing. In everyday social situations, following the crowd is often a perfectly reasonable strategy. If everyone in a crowded restaurant is eating the soup, there is probably a good reason for it. But in financial markets, the crowd is almost always wrong at the extremes. When everyone is euphoric and buying enthusiastically, prices tend to be at their highest, and the expected future returns tend to be at their lowest. When everyone is terrified and selling desperately, prices tend to be at their lowest, and the expected future returns tend to be at their highest. The investor who can go against the crowd at these extremes, who can be greedy when others are fearful, and fearful when others are greedy, as Buffett famously put it, will almost always come out ahead over the long run. Baid does not simply name these biases and move on. He goes into considerable depth about how to build psychological defenses against them, how to structure your thinking and your behavior in ways that reduce the power these biases have over you. He talks about the importance of having a clear investment checklist that you go through before making any major decision so that your analysis is disciplined and systematic rather than driven by emotion. He talks about the importance of maintaining a written record of your investment thesis when you first buy something so that when the stock falls and fear and doubt begin to creep in, you can go back and read what you actually thought at the time, rather than letting your current fear rewrite your past reasoning. He talks about the importance of surrounding yourself with people who think independently and who will challenge your ideas rather than simply agree with you, because unchecked agreement is one of the greatest enemies of clear thinking. The concept of a checklist deserves particular attention because Baid treats it as one of the most practical and powerful tools available to the thoughtful investor. The idea of using checklists to improve decision-making under pressure did not originate in the world of investing. It came from aviation and medicine, where researchers discovered that even highly trained, highly experienced professionals make critical errors when working from memory alone, errors that a simple written checklist can prevent. Atul Gawande, the surgeon and writer, popularized this insight in his wonderful book about checklists, and Baid draws on Gawande's work to argue that the same logic applies perfectly to investing. When you are in the middle of making an important investment decision, you are under a kind of psychological pressure that makes it easy to overlook things you know perfectly well in calmer moments. A well-designed checklist forces you to slow down and go through every important question systematically, reducing the chance that excitement, fear, or cognitive overload will cause you to miss something critical. Baid shares his own investment checklist in the book, and it is a remarkably comprehensive document that covers every major aspect of business quality, management integrity, financial health, competitive dynamics, valuation, and risk factors. Some of the questions on his checklist include things like, is this business in an industry with attractive long-term economics? Does the business have a durable competitive advantage that will still be relevant 10 years from now? Does the management team have a track record of treating shareholders honestly and allocating capital wisely? Is the balance sheet strong enough to survive a severe economic downturn? Is the business generating real cash, not just accounting profit? And is the current price reasonable relative to the business's likely future earnings power? Going through a checklist like this systematically before every significant investment decision may feel slow and cumbersome, but Baud argues persuasively that the slowness is actually one of its greatest virtues. It forces you to think, and thinking carefully and thoroughly is exactly what good investing requires. Closely connected to the idea of quality businesses and durable competitive advantages is one of the most important and widely discussed concepts in the world of value investing, the concept of the economic moat. Warren Buffett first popularized this term using the image of a medieval castle surrounded by a deep water-filled moat to describe a business that has protection against competitive attack. Just as a castle with a deep moat is very hard for enemies to capture, a business with a deep economic moat is very hard for competitors to defeat. But what exactly creates an economic moat, and how can an investor identify one when they see it? Baid explores this question in rich detail, identifying several different sources of competitive advantage that can create lasting moats. The first, and perhaps most powerful, is what is called a network effect, which occurs when a product or service becomes more valuable to each individual user as the total number of users grows. Social media platforms are the most obvious modern example of this. A social network with 100 million users is far more valuable to each individual member than a social network with 1,000 users, because there are so many more people to connect with, to share things with, and to interact with. This means that once a social network reaches a critical mass of users, it becomes almost impossible for a competitor to displace it, because a new entrant would have to start with a tiny network that offers far less value, and convincing people to leave the established network for a smaller, less valuable one is extraordinarily difficult. The same logic applies to payment networks, to marketplaces, to operating systems, and to many other types of businesses where the value of the service increases with the number of participants. The second source of moat is what Baid calls switching costs, which refers to the difficulty and cost that customers face when they want to change from one product or service to another. Switching costs can be financial, like the fees you pay to break a contract, or they can be practical, like the time and effort required to migrate your data from one software system to another and retrain all your employees. They can also be psychological, like the comfort and familiarity you feel with a product you have used for years compared to the uncertainty and learning curve of something new. Businesses with high switching costs have a form of captive audience, because even if a competitor offers a somewhat better product at a somewhat lower price, the hassle and cost of switching may simply not be worth it to most customers. Enterprise software companies are a classic example of businesses with high switching costs. Once a large company has integrated a particular software platform deeply into its operations, the prospect of replacing it is so daunting that most companies will stick with the existing platform through years of imperfections and frustrations rather than face the disruption of changing. The third source of moat is cost advantage, which means the ability of a business to produce its products or deliver its services more cheaply than any competitor can. Cost advantages can come from many sources, including economies of scale, meaning the ability to spread fixed costs over a very large number of units so that the cost per unit falls as volume increases. They can come from proprietary technology or production processes that competitors do not have access to. They can come from geographic advantages, such as having a quarry or a mine or a power plant located close to the customers who need its output, saving on transportation costs that distant competitors must bear. Businesses with genuine cost advantages can either charge lower prices than competitors and gain market share, or charge similar prices and earn higher profit margins than competitors. Either way, the cost advantage translates into a durable ability to generate superior returns over time. The fourth source of moat is intangible assets, which includes brands, patents, licenses, and regulatory approvals. A strong brand, like those associated with the world's most trusted consumer companies, is a form of pricing power. Customers who trust a brand are willing to pay a premium for its products over those of competitors, even when the underlying product is not dramatically better. Patents give a company the legal right to prevent others from copying its innovations for a period of time, which can be enormously valuable in industries like pharmaceuticals, where a single successful drug can generate billions of dollars in revenue. Regulatory licenses and approvals can create almost impenetrable barriers to entry in industries like banking, insurance, and utilities, where a new entrant must navigate years of regulatory scrutiny before it can even begin to compete. Baid is careful to point out that not all apparent moats are equally durable, and that one of the most important skills in investing is distinguishing between a genuine deep moat and what might be called a pseudo-moat, a competitive advantage that looks solid today but is more fragile than it appears. Technology, in particular, has proven to be a great destroyer of moats that once seemed permanent. Companies that dominated their industries for decades have been brought to their knees by technological disruption, and the investor who fails to think carefully about how emerging technologies might affect the competitive advantages of the businesses they own can suffer very large losses. Baid gives considerable attention to the importance of thinking about the second and third order consequences of technological change, meaning not just the immediate and obvious effects, but the less obvious downstream effects that only become visible when you think several steps ahead. The question of management quality is another theme that runs very deeply through the book, and Baid treats it with the seriousness it deserves, because his experience as an investor has taught him that even the most wonderful business can be destroyed by bad management, and even a mediocre business can be transformed into something remarkable by exceptional management. Assessing management quality is one of the hardest things an investor has to do, because managers are almost always putting their best face forward in public, saying all the right things about shareholder value and long-term thinking and capital allocation discipline. The real test of management quality is not what they say, but what they do, and specifically, what they do when difficult choices have to be made between what is best for shareholders in the long run and what is most comfortable or rewarding for management in the short run. Baid looks at several dimensions of management quality. The first is capital allocation, which refers to the decisions management makes about where to invest the cash that the business generates. A business that generates large amounts of cash has several options for where to put that cash. It can reinvest it back into the core business to fuel growth. It can make acquisitions of other companies. It can pay dividends to shareholders. It can buy back its own shares. Or it can simply accumulate it on the balance sheet as a cushion against uncertainty. Each of these options has different implications for shareholders, and the quality of management's capital allocation decisions over time is one of the most reliable indicators of whether that management is genuinely focused on creating value for shareholders or primarily focused on building their own empires and enriching themselves. The second dimension of management quality is integrity, and Baid argues that this is non-negotiable, a threshold condition that must be met before any other consideration about a management team can even be evaluated. A management team that is not honest with its shareholders, that uses accounting tricks to flatter its reported results, that pays itself outrageous compensation regardless of how the business is actually performing, that takes related party transactions that enrich insiders at the expense of other shareholders. This kind of management will eventually destroy value no matter how good the underlying business might be. And Baid goes further, arguing that the way management behaves in the small things, the details of their communication, the accuracy of their forecasts, the consistency between what they promise and what they deliver, these small things are often the most reliable indicators of their overall character. If a management team consistently oversells the strength of the business in good times and makes excuses in bad times, if they regularly miss the guidance they themselves have given and never seem to take responsibility for it, these are red flags that should make any serious investor very cautious. The third dimension is the quality of thinking that management brings to the strategic challenges and opportunities facing the business. Does the management team have a clear and coherent understanding of what makes their business competitive? Do they understand where the industry is headed and how technology might disrupt or create opportunities in their market? Do they make bold and intelligent moves when the situation calls for boldness? And do they show discipline and restraint when the situation calls for caution? Do they communicate clearly and honestly about both the strengths and the weaknesses of the business? Or do they only talk about the positives? These questions do not have simple yes or no answers, and building reliable judgments about them requires reading many years of annual reports, listening to many earnings calls, studying the management's track record across multiple economic cycles, and sometimes having direct conversations with the people involved. Baid writes extensively about the importance of reading annual reports carefully and thoughtfully, treating them not as dry compliance documents, but as windows into the character and thinking of the management team. He has a particular fondness for letters to shareholders written by owner-operators, meaning people who have a very large percentage of their personal wealth invested in the same shares as other shareholders, because such letters tend to be more candid, more thoughtful, and more genuinely focused on long-term value creation than the letters produced by management teams that are primarily employees rather than owners. Buffett's annual letters to Berkshire Hathaway shareholders are the gold standard in this genre, and Baid quotes from them extensively throughout the book, not just for their insights about investing, but for their wisdom about business, about life, and about the qualities of mind and character that lead to success in any endeavor. When it comes to valuation, which is the question of how much to pay for a business, Baid takes a thoughtful and nuanced position that avoids both the extreme of being obsessed with numerical precision and the extreme of ignoring price entirely. He is deeply influenced by Buffett's evolution on this topic, from the early days of buying businesses cheaply, regardless of quality, to the more mature philosophy of buying wonderful businesses at fair prices rather than fair businesses at wonderful prices. The key insight here is that for a genuinely high-quality business with a strong moat, a talented management team, and a long runway of growth ahead of it, paying a somewhat higher price is perfectly justified because the compounding power of the business will overcome an initially high entry price over a long enough period of time. However, Baid is also careful to point out that this logic has limits. There is a price for any business, however wonderful, above which the investment cannot be expected to generate satisfactory returns, simply because you have paid so much up front that the future growth cannot compensate. This is why he argues that a thorough understanding of intrinsic value, meaning an estimate of what a business is actually worth based on its future cash-generating ability, is an essential tool for every serious investor. He does not advocate for precise discounted cash flow models that give the illusion of mathematical certainty. He advocates for a range of estimates, a sense of the likely intrinsic value under different assumptions, and an insistence on paying a price that is meaningfully below the low end of that range, providing what Graham called a margin of safety. The concept of margin of safety is one of the most important ideas in all of value investing, and Baid traces its history from Benjamin Graham, who first articulated it, through Buffett and Munger, who adapted it for the modern world of high-quality businesses. The margin of safety is essentially the gap between what you pay for a business and what you think it is worth. If you pay 10 times earnings for a business you think is worth 20 times earnings, your margin of safety is 50%. If you pay 18 times earnings for a business you think is worth 20 times earnings, your margin of safety is only 10%. The larger the margin of safety, the more protected you are against being wrong in your analysis, because even if your estimate of intrinsic value turns out to be too optimistic, the gap between your purchase price and your estimate means you have some cushion to absorb the error. For ordinary businesses with average economics, Baid advocates for a generous margin of safety because the risk of being wrong is high and the consequences of being wrong can be very costly. For exceptional businesses with genuine moats and proven management teams, a somewhat smaller margin of safety may be acceptable because the risk of being drastically wrong is lower, and the cost of waiting for a larger discount, which may never arrive, can be the loss of a lifetime compounding opportunity. This is a judgment call that every investor must make for themselves, and Baid is honest that there is no formula or algorithm that can make it for you. It requires the integration of all your knowledge about the business, the industry, the management, the competitive dynamics, and the overall market environment, filtered through a framework of disciplined thinking and seasoned judgment. One of the most powerful and memorable sections of the book deals with the question of how long to hold an investment. Most investors, even those who subscribe intellectually to the idea of long-term investing, find it very difficult in practice to hold a stock for 10, 15, or 20 years. There are always new opportunities that seem more attractive. There are always short-term disappointments that raise doubts about whether the original thesis was right. There are always market fluctuations that create the tempting illusion that you can sell at a high point and buy back at a lower point. And there are always other people, friends, colleagues, and commentators offering opinions about why the stock you own is overpriced or why some other stock is much more attractive right now. Baid argues forcefully against the constant churning of a portfolio that these temptations produce. He draws on the concept of long-term ownership as practiced by the greatest investors, showing through historical examples that the returns generated by truly long-term holding of exceptional businesses have been dramatically superior to the returns generated by more frequent trading. The reason is compounding again. A business that compounds its intrinsic value at 15% per year will double its intrinsic value roughly every 5 years. Hold it for 20 years, and its intrinsic value will have grown to more than 16 times what it was when you bought it. But this extraordinary result requires that you hold through all the inevitable periods of underperformance, temporary disappointment, and market misunderstanding that will occur along the way. The investor who sells after the first year of poor returns, or the second, or the fifth, will never see the miraculous result that patient holding eventually delivers. Baid also addresses a question that many investors find genuinely difficult, which is when it is appropriate to sell. He does not advocate for holding everything forever, regardless of what happens. There are legitimate reasons to sell a business you own, and he identifies several of them. The first, and most important, is when your original investment thesis has been fundamentally disproved, meaning the competitive advantage you thought the business had has turned out not to be real, or the management you trusted has revealed itself to be dishonest or incompetent. The second is when the price has risen so far above your estimate of intrinsic value that the business is genuinely and substantially overpriced, providing little margin of safety and very modest expected returns from the current level. The third is when you have found a demonstrably better opportunity and need to raise capital to invest in it. But he is very clear that the price has fallen, and I am nervous, is not a reason to sell, and everyone seems to be selling, and I feel left out, is not a reason to buy. These are emotional reactions, not analytical judgments, and they almost always lead to poor outcomes. The book also spends considerable time on what Baid calls avoiding the big mistake, which he considers at least as important as finding the big winner. The history of investing, and the history of business more broadly, is littered with examples of investors who built large fortunes through years of careful, disciplined work, and then lost much of it through a single catastrophic decision. The risks that are most dangerous to an investor's long-term wealth are not the small mistakes, the investments that disappoint slightly and generate mediocre returns. The truly dangerous risks are the ones that can result in a permanent loss of a large percentage of capital, because capital that is permanently lost cannot compound, and the loss of compounding over many future years is far more damaging than any immediate financial loss. Baid identifies several categories of investment that carry a particularly high risk of permanent capital loss. The first is companies with excessive debt, because a company that carries too much debt is vulnerable to sudden and catastrophic failure in any period of economic stress. A business with no debt can survive a bad year, or even several bad years, because it has no mandatory interest payments that must be made, regardless of how the business is performing. But a business with heavy debt obligations must make its interest payments even in the worst of times, and if revenues fall sharply and the debt cannot be serviced, bankruptcy can follow quickly. Baid is particularly insistent on avoiding businesses with heavy debt in cyclical industries, where revenues are inherently unpredictable and can fall dramatically during economic downturns. The second category of high risk is businesses in industries undergoing rapid and unpredictable technological disruption. These are industries where a new technology is emerging that could potentially make the existing business model obsolete, and where it is genuinely unclear whether the disruption will happen gradually over many years, giving the established players time to adapt, or rapidly over just a few years, leaving them no time to respond. The history of technology is full of examples of once great businesses that were destroyed by disruption they did not see coming, from photographic film companies unable to adapt to the digital revolution, to taxi companies overwhelmed by ride-sharing platforms, to retail businesses devastated by the rise of e-commerce. Baid does not say that investors should never invest in businesses facing technological disruption. He says they should be extremely cautious, should reduce their expected returns to reflect the uncertainty, and should always make sure they have a wide enough margin of safety to absorb the possibility that the disruption turns out to be worse and faster than expected. The third category is businesses where there is genuine doubt about the integrity of the management or the reliability of the financial statements. Accounting fraud is a real and recurring phenomenon in the business world, and while most investors do not like to think about it, the history of financial markets includes many cases of companies whose reported results turned out to be false, sometimes for many years, before the truth emerged and the share price collapsed. Baid gives careful attention to the red flags that might indicate accounting manipulation, including things like revenues that grow much faster than cash collections, profits that consistently exceed cash flow from operations, frequent changes to the accounting policies that happen to have the effect of flattering the reported results, unusually complex financial structures that make it difficult for outside analysts to understand what is really happening, and management teams that are very aggressive and defensive when analysts ask probing questions about their financial statements. Running through all of these discussions of risk and reward is a theme that Baid returns to again and again throughout the book, which is the absolute importance of intellectual honesty with yourself. This is perhaps the hardest skill of all to develop, because human beings are naturally inclined to protect their ego and their sense of competence by finding reasons to believe they are right and reasons to dismiss evidence that suggests they are wrong. Psychologists call this confirmation bias, the tendency to search for, notice, and give weight to information that confirms your existing beliefs, while unconsciously filtering out or downplaying information that contradicts them. In investing, confirmation bias is particularly dangerous because the financial stakes are high and the feedback loops are long and complex, meaning it can take years before you discover whether an investment decision was right or wrong, giving you plenty of time to construct elaborate justifications for whatever you did. The antidote to confirmation bias, Baid argues, is to actively seek out the strongest possible arguments against your current investment positions. Not the weakest arguments, but the strongest ones. Find the most intelligent people who disagree with you and read their analysis carefully. Try to steelman the opposing view, meaning construct the most compelling version of the argument against your position that you can imagine. Ask yourself, what would have to be true for you to be wrong, and then honestly assess how likely those conditions are. This is deeply uncomfortable work because it means spending significant time and energy trying to undermine your own convictions. But it is the only reliable way to protect yourself against the very costly mistake of holding a conviction that you believe is based on careful analysis, but is actually based on ego and self-deception. One of the most beautiful aspects of the book is the way Baid connects investing philosophy to a broader philosophy of life. He does not treat investing as a purely commercial activity, a way of making money that is separate from the rest of your existence. He treats it as a microcosm of the larger challenge of living wisely and well. The qualities that make a great investor: patience, intellectual honesty, continuous learning, emotional discipline, the willingness to be wrong and learn from it. These are also the qualities that make a great human being in any domain of life. And conversely, the character failings that destroy investors: greed, impatience, arrogance, self-deception, the inability to delay gratification. These are also the failings that tend to damage lives and relationships outside of investing. Baid draws on a wide range of thinkers from outside finance to illuminate these connections. He quotes from Marcus Aurelius and the Stoic philosophers about the importance of focusing on what you can control and accepting with equanimity what you cannot. He draws on the ideas of the great psychologist Mihai Csikszentmihalyi about the state of deep engagement and satisfaction that comes from doing work that fully uses your capabilities, what Csikszentmihalyi called flow. He references the research of Carol Dweck about the difference between a fixed mindset, which treats ability as innate and static, and a growth mindset, which treats ability as something that can be developed through effort and learning. He brings in ideas from Nassim Taleb about the importance of being robust to unpredictable events and about the dangers of optimizing too narrowly for measured outcomes while ignoring the unmeasured risks that can destroy you. This intellectual breadth is one of the great pleasures of the book. Reading it feels like a conversation with someone who has read deeply and thought carefully across an enormous range of human knowledge, and who has the ability to connect ideas from very different fields in ways that illuminate all of them. Baid clearly takes great joy in this kind of synthesis, and his enthusiasm for ideas is infectious. You come away from the book not just with a better understanding of investing, but with a desire to read more, think more, and develop your own latticework of mental models across as many fields as possible. The question of how to live a good life, not just a financially successful life, is one that Baid takes seriously throughout the book, but particularly in the later chapters, where he reflects on the deeper purposes that all this investing and wealth building are meant to serve. He is clear that money itself is not the ultimate goal. Money is a tool, a means to an end, and the ends that matter, the things that actually create a sense of meaning, fulfillment, and happiness in a human life, are things that money can support but cannot replace. Loving relationships with family and friends, work that engages your mind and develops your capabilities, health that allows you to enjoy the life you have built, the freedom to spend your time on things you find meaningful rather than things you feel compelled to do. These are the real goals, and Baid argues that the discipline and patience required to build wealth through long-term investing are actually excellent training for the broader project of living wisely and well. He writes about the importance of knowing what you want from life before you can know how much money you actually need. Many people pursue more and more money without ever asking themselves what it is for, without ever defining what enough looks like. As a result, they spend their lives accumulating far more than they could ever use or enjoy, often at the cost of the time, relationships, and experiences that would have made their lives genuinely rich. Baid is not advocating for poverty or for indifference to financial security. He understands very well the importance of having enough wealth to be free from constant financial anxiety and enough to provide for the people you love. But he argues that beyond a certain level of financial security, the marginal value of additional wealth decreases rapidly, while the cost of pursuing it, in terms of time, stress, missed experiences, and damaged relationships, can be very high. The wise person defines what enough looks like for them, works to achieve that, and then focuses their remaining energy on the things that truly matter. This connects to a theme that runs throughout the book about the importance of giving back, of using whatever wealth and knowledge and capability you have accumulated to make a positive contribution to the lives of others. Baid writes admiringly about the great philanthropists in the investing world, particularly about the extraordinary commitment that Buffett and Gates have made to giving away the vast majority of their wealth, and about the inspiring example of others in the investing community who have made generosity and social contribution central parts of their lives. He draws a connection between the mindset of the long-term investor and the mindset of the philanthropist, arguing that both require the ability to defer immediate gratification in service of a larger long-term good. Both require confidence in a positive future even when the present is uncertain and challenging. And both are animated by a genuine concern for outcomes that extend beyond the self. The concept of simplicity comes up repeatedly in the book, and Baid treats it not as an absence of sophistication, but as its highest expression. The wisest investors, the ones with the deepest understanding and the most reliable track records, tend to have very simple frameworks for thinking about businesses and very simple portfolios that consist of a small number of positions they know extremely well. They do not own 50 or 100 stocks because they understand that it is not possible to know 50 or 100 businesses deeply enough to have genuine conviction about each one. They own perhaps 10 or 15 businesses at most, each of which they have researched exhaustively, each of which they understand thoroughly at every level, from the competitive dynamics of the industry to the character of the management team to the details of the financial statements. And they hold these businesses for years, or even decades, watching the compounding work its gradual magic, resisting every temptation to tinker, trade, or chase new excitement. This simplicity extends to their personal lives as well. The great investors tend not to be flashy or extravagant. They live modestly relative to their wealth. They maintain consistent daily routines that prioritize reading and thinking. They cultivate a small circle of trusted intellectual companions rather than a large network of superficial acquaintances, and they measure their success not by the size of their bank account or the number of companies they own, but by the quality of their thinking and the depth of their wisdom. Buffett famously still lives in the same house he bought in Omaha in 1958 for $31,500. He still eats breakfast at McDonald's when he is feeling indulgent. He still spends the majority of his working day reading and thinking rather than attending meetings or making phone calls. This simplicity is not an affectation. It is the outward expression of a clear set of values and priorities that put thinking, wisdom, and genuine connection above show, status, and the restless acquisition of things. Another deeply important concept in the book is what Baid calls the disposition effect, and the broader question of when investors should update their views versus when they should hold firm. The disposition effect is the behavioral tendency to sell investments that have gone up in value, taking profits, and to hold investments that have fallen in value, waiting to get back to even. This is almost exactly the opposite of rational behavior. If a business has risen sharply in price because its intrinsic value has genuinely increased, you should probably hold it or even buy more, not sell. And if a business has fallen in price because its intrinsic value has genuinely deteriorated, you should probably sell, not hold and hope. The challenge is distinguishing between a price change that reflects a genuine change in the underlying business value and a price change that merely reflects the mood of the market. This distinction is at the heart of the entire value investing philosophy. The market, as Benjamin Graham famously observed, is not a mechanism for discovering the true value of a business. It is a voting machine in the short run, reflecting the popularity of different investments at any given moment, and a weighing machine in the long run, eventually recognizing and reflecting the actual business value that was created or destroyed over time. The investor who understands this distinction, who can look past the daily votes of the market and focus on the underlying weighing of business value over years and decades, has a genuine and lasting edge over the majority of market participants who confuse popularity with value and who let the daily fluctuations of prices tell them how to feel and what to do. Baid also addresses the temptation of what he calls macro investing, which refers to making investment decisions primarily on the basis of predictions about the overall economy, interest rates, exchange rates, commodity prices, or other large-scale macroeconomic variables. Many sophisticated investors and many financial media commentators spend enormous amounts of time and energy forecasting these things, and the forecasts are frequently presented with great confidence and authority. But the empirical record of macroeconomic forecasting is remarkably poor. Even the most respected economists and analysts have a track record of being wrong about macro variables far more often than they are right, and the timing of their predictions is even more unreliable than the direction. Baid argues, following Buffett and Munger, that trying to make investment decisions based on macro forecasts is not just unhelpful, but actively harmful, because it distracts attention from the things you can actually know, such as the quality of a particular business, the strength of its competitive position, and the reasonableness of its current valuation. This does not mean ignoring macroeconomic conditions entirely. It means giving them appropriate weight, using them as context rather than as the primary basis for decisions. If interest rates are very high, that is relevant context for thinking about the valuation of all businesses, because the return available from safe investments like government bonds affects the price that rational investors should be willing to pay for riskier assets. If the economy is in a deep recession, that is relevant for thinking about the near-term revenues and earnings of cyclical businesses. But these macro factors should inform the range of scenarios you consider and the margin of safety you demand, not override your fundamental analysis of the quality and value of specific businesses. One of the most intellectually rich parts of the book deals with the concept of probabilistic thinking and its application to investing decisions. Most people think in terms of single-point predictions. They think a stock will go to a certain price, or a business will grow at a certain rate, or an economy will enter recession in a certain year. But Gautam Baid, following the lead of thinkers like Howard Marks and Michael Mauboussin, argues that the right way to think about uncertain future outcomes is in terms of a range of possibilities and the probabilities attached to each. Instead of saying, this business will grow at 15% per year, the sophisticated investor thinks, there is perhaps a 40% chance that this business will grow at 20% per year, a 40% chance it will grow at 10% per year, and a 20% chance that something will go badly wrong and it will barely grow at all. With this kind of probabilistic thinking, you can make much more nuanced and well-calibrated decisions about how much to pay for an investment and how much of your portfolio to allocate to it. Baid introduces the concept of expected value to connect this probabilistic thinking to actual investment decisions. The expected value of an investment is calculated by multiplying each possible outcome by its probability and adding up the results. An investment with a 40% chance of doubling in value, a 40% chance of growing by 20%, and a 20% chance of losing 50% of its value has an expected value calculation that you can work through to arrive at a single number representing the most likely average outcome across many such investments. But Baid is careful to point out that expected value calculations are only as good as the probability estimates that go into them, and estimating probabilities in complex, real-world business situations is extremely difficult. The value of the expected value framework is not precision, but structure. It gives you a way of thinking systematically about all the possible outcomes and their relative likelihoods, rather than just fixating on the single most likely scenario and ignoring everything else. The book also contains a thoughtful and balanced discussion of the question of concentration versus diversification in a portfolio. Most conventional financial advice emphasizes diversification as the primary tool of risk management, and there is genuine wisdom in this. If you spread your investments across many different businesses, industries, and geographies, you reduce the risk that any single bad outcome will devastate your overall portfolio. The failure of one company out of 50 matters far less than the failure of one company out of 5. This logic is sound, and for most individual investors who do not have the time, knowledge, or inclination to research businesses deeply, a highly diversified low-cost index fund is probably the best possible investment. But Baid is writing for a somewhat different audience, namely, the investors who do want to do deep research, who do want to develop genuine expertise about a small number of businesses, and who believe that concentrated positions in things you know very well can generate returns that are significantly better than those available from broad diversification. His argument for concentration is essentially that diversification is a hedge against ignorance. If you know very little about each of the 50 businesses you own, you need diversification to protect you from the risk that your ignorance about any one of them will prove very costly. But if you know a great deal about each of the 10 businesses you own, having researched them exhaustively, understood their competitive positions deeply, and followed their management teams closely for years, your knowledge is a more powerful tool of risk management than diversification, because it substantially reduces the probability that you are wrong in ways that could be devastating. This argument is compelling in theory, but Baud is honest about its practical challenges. Genuine deep knowledge about a business is very hard to acquire and even harder to maintain over time as industries evolve and management teams change. The investor who believes they have deep knowledge about a business but is actually in possession of only superficial familiarity is in a genuinely dangerous position if they have concentrated their portfolio heavily in that business. This is why Baud combines his argument for concentration with an equally strong argument for intellectual humility and for the kind of relentless questioning of your own assumptions that can protect you from the self-deception of thinking you know more than you do. The chapters on learning from mistakes are among the most valuable in the book because Baid writes about them with genuine personal vulnerability and honesty. He does not present himself as someone who has always been right or who figured everything out early in his career. He presents himself as someone who has made many mistakes, has suffered the painful consequences of those mistakes, has taken the time to analyze them carefully and understand what went wrong, and has tried his very best to incorporate the lessons into his future behavior. This willingness to examine failure honestly and extract lessons from it is, he argues, one of the most important qualities that distinguishes great investors from merely good ones. He identifies several categories of mistakes that he has made and that he has observed other investors make. The first is errors of commission, meaning things you did that you should not have done, such as buying a business you did not understand well enough, paying too high a price for a genuinely good business, ignoring warning signs about management integrity, or failing to sell when the investment thesis was clearly disproved. The second is errors of omission, meaning things you failed to do that you should have done, such as failing to buy a great business when it was available at a reasonable price, because you were too cautious or too focused on other things, or failing to add to a great position when the price fell and the opportunity to buy more at a better price was right in front of you. Both categories of mistakes are worth analyzing carefully, but Baid suggests that errors of omission often get less attention than they deserve because they are less visible. The mistake you did not make leaves no obvious trace in your portfolio, while the mistake you did make is right there in the numbers for you to see. He also writes about a category of mistakes that is particularly relevant to the world of value investing, which he calls value traps. A value trap is a business that looks cheap by conventional valuation measures, such as a low price to earnings ratio or a low price to book value, but is cheap for good reasons that are not immediately obvious. Perhaps the business is in a structurally declining industry, slowly losing customers to new competitors or new technologies, so that while it looks cheap today, it will look even cheaper or will have disappeared entirely in 5 or 10 years. Perhaps the business has a balance sheet full of assets that are carried at historical cost, but are actually worth much less at current market values. Perhaps the business has a management team that is quietly destroying value through bad capital allocation decisions, even while the reported earnings per share look attractive. Learning to distinguish genuine value from value traps is a skill that develops slowly over many years of experience and careful study, and Baid offers thoughtful guidance on the kinds of questions to ask and the kinds of warning signs to look for. Throughout the book, Baid is careful to credit the thinkers and investors who have shaped his own thinking, and the list is long and impressively diverse. Buffett and Munger are the most frequently cited, as you would expect, but he also draws deeply on Benjamin Graham, the father of value investing, whose books, Security Analysis and The Intelligent Investor, are still essential reading for anyone serious about the subject. He quotes from Peter Lynch, whose concept of investing in what you know and understand from your own everyday life is a powerful antidote to the complexity and abstraction that often dominate investment analysis. He draws on Howard Marks, whose writings about the investment cycle and the importance of understanding where you are in the market's mood at any given time are some of the clearest and most useful thinking in the field. He references Joel Greenblatt, whose work on magic formula investing demonstrates that simple, systematic approaches to finding cheap, high-quality businesses can generate very attractive returns over time without the need for great complexity or great insight. He draws on Seth Klarman, whose book, Margin of Safety, is one of the most rigorous and demanding examinations of value investing ever written. The sheer breadth of Baid's reading and thinking is itself one of the book's most important messages. The message is that investing, done at the highest level, is a multidisciplinary intellectual endeavor that draws on everything from the hardest sciences to the softest humanities. The investor who limits their reading to financial analysis and investment books is like the doctor who only reads medical journals and never reads about nutrition, exercise, psychology, or the social determinants of health. They will be competent, perhaps, but they will miss the connections and insights that come from a broader perspective, and in a field as complex and unpredictable as financial markets, those missed connections can be enormously costly. Baid writes beautifully about the experience of reading as a form of conversation with the greatest minds across human history. When you read a book by Marcus Aurelius, you are in conversation with a man who was both the most powerful person in the known world and one of the most thoughtful philosophers of his era. When you read a book by Benjamin Franklin, you are in conversation with one of the most practically intelligent and inventive minds the modern world has produced. When you read a book by Darwin, you are following one of the most patient and meticulous scientific minds in history as he works through the evidence for a revolutionary new understanding of life itself. These conversations are available to anyone who can read, regardless of where they were born, what family they grew up in, or how much money they have. The library, Baid implies, is the great equalizer, the one place where a young person from a modest background in India can sit at the same table as the greatest thinkers in human history and learn from them directly. The concept of a mastermind group, a small circle of trusted intellectual companions who challenge each other's thinking, share knowledge, and hold each other accountable, is one that Baid recommends for every serious investor. He draws on the historical example of Franklin's Junto Club, a group of young working men in Philadelphia who met regularly to discuss ideas and help each other improve, as evidence that such groups have a long and honorable history. In the modern world, such a group might meet in person, correspond by email, share annotated reading lists, or discuss investment ideas in a private forum. What matters is that the members have genuine intellectual respect for each other, genuine commitment to honest discussion rather than mutual congratulation, and genuine openness to having their ideas challenged and their assumptions questioned. The benefits of such a group, both for the quality of your thinking and for the quality of your investing, can be very substantial. In writing about the path of continuous improvement, Baid introduces the Japanese concept of kaizen, which means the practice of small, continuous improvements, little by little, day after day, year after year. Kaizen was famously applied to the manufacturing processes of Toyota and other Japanese companies after the Second World War, with results that eventually made Japanese manufacturing the envy of the world. But the concept applies equally well to personal development in any field, including investing. The investor who commits to getting just a little bit smarter, a little bit more disciplined, and a little bit more patient every single day, without trying to make dramatic leaps or sudden transformations, will compound their capabilities over the years, in the same way that a great business compounds its value, slowly but inexorably, to results that are ultimately extraordinary. Baid pairs the concept of kaizen with the idea of deliberate practice, drawn from the research of psychologist Anders Ericsson, who studied how experts in various fields develop their extraordinary capabilities. Ericsson's research showed that what distinguishes the truly great from the merely good in any field is not talent or intelligence, but the quality and quantity of their practice. Deliberate practice means practicing in ways that push you just beyond your current ability, that focus specifically on your weakest areas, that involve constant feedback and immediate correction of errors, and that are sustained over very long periods of time. In investing, deliberate practice might mean carefully reading and analyzing the financial statements of businesses even when you have no intention of investing in them, just to develop your analytical capabilities. It might mean writing detailed investment memos about businesses you have studied, forcing yourself to articulate your reasoning clearly and to confront the weaknesses in your argument. It might mean reviewing every investment decision you made in the past year, honestly assessing what you did well and what you did poorly, and identifying specific things to do differently in the future. Baid is also honest about the role of luck in investing success and about the importance of not confusing good luck with good skill. In any probabilistic endeavor, some people will get good outcomes even with poor decision-making, and some people will get poor outcomes even with excellent decision-making, simply because of the randomness inherent in complex systems. The investor who made a lot of money in a particular investment because the business performed better than even the most optimistic scenario predicted should be careful about concluding that their analysis was brilliant. Perhaps the business really was exceptional, and their analysis was right. But perhaps the business performed extraordinarily well, largely for reasons that were outside anyone's ability to predict, and the good outcome was more a function of luck than of skill. Making this distinction honestly, rather than claiming all successes as triumphs of skill and blaming all failures on bad luck, is essential for genuine learning and improvement. As the book moves toward its conclusion, Baid brings together all of the threads he has been weaving, connecting the philosophy of investing with the philosophy of life in a way that is genuinely moving and inspiring. He returns to the central metaphor of compounding, but by now, the reader understands that compounding is about so much more than money. Every book you read adds to your store of knowledge, and knowledge compounds as each new piece of learning connects to and illuminates what you already know. Every good relationship you nurture adds to your store of love and social support, and these compound as the people you have been good to are there for you in your times of need, and as their children and yours grow up knowing each other. Every skill you develop adds to your capability, and capabilities compound as each new skill makes you more effective in all the areas that draw on similar underlying abilities. Every act of integrity adds to your reputation, and reputation compounds as each person who has found you honest and trustworthy tells others, who tell others, until your good name precedes you into rooms you have never entered. Baid writes about the importance of patience, not just as an investment strategy, but as a life strategy. In a world that has become increasingly oriented toward immediate gratification, toward fast results and quick rewards and instant satisfaction, the ability to wait, to work quietly and consistently toward a long-term goal without the need for constant visible progress or external validation is increasingly rare and increasingly valuable. The patient person who plants a tree today, knowing they will not sit in its shade for 20 years, who starts a business today, knowing it will take 10 years to reach its potential, who begins reading seriously today, knowing that the payoff will not come until their mental models have had years to deepen and connect. This person is doing something fundamentally different from what most of the people around them are doing. They are playing a different game, one with higher stakes, longer time horizons, and potentially much more magnificent rewards. And Baid argues that this long game is the only one worth playing, not because the rewards are guaranteed, but because the process itself, the daily practice of learning, thinking, building, and growing, is one of the deepest sources of meaning and satisfaction available to a human life. The idea that the journey matters as much as the destination, or perhaps more, is one that Baid returns to repeatedly, and it is what makes this book ultimately so much more than a guide to making money. He writes about the joy of the hunt, the genuine intellectual pleasure of researching a business deeply and slowly, beginning to understand what makes it tick, what makes it special, what could go wrong, and what could go wonderfully right. He writes about the satisfaction of conviction, of making an investment you believe in deeply, and then watching the thesis play out over years, not always smoothly or linearly, but ultimately in the direction your analysis suggested. He writes about the growth that comes from the mistakes, the humbling recognition that you were wrong, the careful autopsy of what went wrong and why, and the quiet determination to do better. These are the experiences that fill an investing life with genuine richness and meaning, and they are available to anyone who approaches investing as a serious intellectual and personal discipline rather than as a get-rich-quick game. In the final chapters, Baid writes about the legacy that the greatest investors have created, not just in financial terms, but in intellectual and human terms. Buffett's letters to shareholders are a legacy of wisdom that will educate and inspire investors for generations. Munger's speeches and lectures are a legacy of interdisciplinary thinking that will influence how people reason and decide long after he is gone. Graham's books on value investing are a legacy of analytical rigor and intellectual honesty that have shaped the thinking of every serious investor for nearly a century. These legacies were not created in a single dramatic act, but through the steady accumulation of knowledge, wisdom, and honest communication over lifetimes of reading, thinking, and doing. They are the ultimate expression of the compounding principle, the result of thousands upon thousands of small acts of learning and sharing, each one modest in itself, but together building something of extraordinary and enduring value. Baid does not present himself as someone who has achieved the wisdom of Buffett or Munger. He is refreshingly humble about where he is in his own journey, acknowledging the mistakes he has made and the lessons he is still learning. What he presents instead is a roadmap, a guide to the principles, practices, and philosophies that he believes, based on his own experience and his deep study of the greatest investors, offer the most reliable path toward becoming a genuinely wise and effective investor over the long term. It is a roadmap that requires patience, because the results of following it will not be visible in weeks or months, but only in years and decades. It requires intellectual honesty, because you will regularly encounter evidence that challenges your assumptions and your convictions, and you must face that evidence honestly rather than explaining it away. It requires courage, both the courage to hold positions that the market is disagreeing with, and the courage to change your mind when the evidence genuinely warrants it. And it requires a genuine love of learning, because the process of becoming a great investor is fundamentally a process of becoming a more broadly and deeply educated human being, and that process, by its nature, never ends. The book closes on a note of genuine warmth and inspiration. Bade expresses his deep gratitude for the privilege of being able to spend his working life doing something he loves, reading, thinking, and trying to understand the world of business and human behavior more deeply. He expresses gratitude for the great thinkers and investors who have shared their wisdom so generously through their writing. He expresses hope that readers of his book will find in it some of the inspiration and practical guidance that might help them on their own journeys, whether those journeys are primarily about building wealth, or about building wisdom, or about building lives of meaning and purpose that happen to include financial prosperity as one element among many equally important ones. This book is, in the truest sense of that overused phrase, a gift. It is the distillation of decades of reading, thinking, and living by a man who has taken the project of self-improvement deeply seriously and has found extraordinary riches in that project, not just the financial riches that his investment career has generated, but the riches of a genuinely educated mind, a genuinely examined life, and a genuinely generous spirit that wanted to share what he had found with as many people as possible.